Am I? And we are live. Hello, 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 and welcome. This is me, Sanchaita, and this is workshop number 2 of the 3-part workshop that we have on how to trade the financial markets. This is a special 3-part workshop that I'm doing for the pandemic. Hello, yeah, hello, Nurul. Thank you for being here. And so this is a 3-part the workshop that I'm having for during the lockdown period for anybody who wants to learn how to trade the financial markets from home. Learn a new skill. If in case you have missed the part 1, if you can just go to the website, it should be somewhere here. Yes, that forexdiva.co.uk/24/7. And you can download our PDF. That will take you, the thank you page will take you to our Facebook group. And that is where all the magic happens. That's where I nurture you. I share my knowledge, and you ask me the questions, your Forex questions, and that's where I answer it. Before I go further, can you hear me? Because I once did an entire webinar and nobody heard me. Can you hear me? Can you just type yes if you can hear me? Yeah, anybody? If you can hear me, just type a yes or give me a like or whatever. I hope you can hear me. Yes, fantastic. Fantastic. Thank you. So there we go. We can go further now. So if this 3-part is, imagine the entire Forex journey that we're going through, the 3-part workshop. If I can thank you loud and clear. Oh wow, I can hear you. Oh, fantastic. I did this the second one. The first one we did at 4 o'clock in the afternoon, and then a lot of people couldn't join us, so hopefully this time it's at 8 o'clock so people can. And so I welcome all of you here. Hello Kingsley, and hello Barry. I hope Barry from America, right? Because the last time some of them in America were still working. So hopefully this time they can, they can come and be here with us. I'm delighted. As like last time, if you are watching live, can you just say #live with the country or a place where you are watching it from? Like, for example, I'm saying this from London, so #live London. So if you can just let me know that. And if you're not watching it live, watching a replay, then if you can just say #replay and the country you're watching from, that would really help, because it's nice to know where everybody's watching from. And then, we're just together in this. So there we go. And today, last time, I know a lot of people were excited and they said that, Barry from Canada. Okay. Who else? Who else is there? I can. Nurul from Ireland, live from America, Wales, Nigeria, USA. Oh, fantastic! Well done and welcome. Last time I had one. You said that you wanted more charts. So this time I'm having less of the presentation, and we'll be working more on the charts, because I love the way how this small group has turned out into a community. And you tell me, I'm just a facilitator. You tell me what you want, and I provide you that. And that's how we progress in our Forex journey. Okay, so today we're going to talk about how say, for example, we are trading the market is, let's compare it to baking a beautiful chocolate cake. So the part 1 was buying the ingredients. So we knew about, what is Forex, how it's done, what is traded, who trades it, when is, best time to trade. Today it's going to be creating something, a beautiful chocolate cake out of that ingredient. So we're going to talk about how to use the charts, what to use, what are time frames, what is price action, candlesticks and indicators, all that stuff. So basically we are baking, the ingredients, we are putting it together for the lovely chocolate cake. And part 3 will be actually putting the cake in the oven to bake. So placing the tray, and what is the stop loss, what is a limit order, all that stuff that is very, very essential for you to know before you start trading. And of course the learning goes on and on. Okay, so let us begin. But can you see my screen? Share screen. If you let me know if you can see my screen, that would be lovely. I can type yes if you can see my screen. Yeah. Okay, and before we move on, I just have to say a disclaimer because Forex trading is this is for educational matters only, and it is Forex trading is risky, so you have to be careful with your money, all that. But if you can read there what is there in the disclaimer, that'd be nice, and then we can carry on. There we go. So workshop 2. For first part, as I said earlier, we had a recap of what is Forex, what is traded, how it is traded, and all that. And then today we're going to talk about trend lines, reading the chart, identifying trend lines. So let us begin. What is a trend line? Trend lines is a visual representation of support and resistance in any time frame. They show directions and speed of price and also describe patterns during periods of price contraction. Okay, I say this because I was taught like that, and that is what you'll find if you search online. But I like to keep things simple. And so let's learn trend lines in the Forex Diva way. Trend line is just a line or a way. It's a presentation saying that the market is moving up, moving down, or moving sideways. And when I show you what the trend lines look like on the chart, it'll be much more simpler. But there are 3 different kinds of trend line. There are 2 major trend lines, which is the uptrend and the downtrend. So that is an uptrend. Imagine the market going up like that, and then the market goes down like that. So these are the major trends, the uptrend and the downtrend. And then we have something called a ranging market, which is sideways. The market is not doing much. There's not much action happening there. So it's just going sideways. So that is called a ranging market. A lot of people say a box or consolidation or ranging market. It's basically going sideways. So uptrend is where the price is moving up, and a downtrend is when the price is moving lower. And how can we identify an uptrend? We have, imagine the trend when the price action, suppose this is a price action, it's going up. It's like a pair of, a staircase. So this part is higher than this, and this is higher than this. Similarly, this is the higher low. It's called higher highs and higher lows. Again, another financial word that we use often, but it says it just imagine, compare it to a staircase going up and a staircase going down. So there are higher highs and higher lows, and there are lower highs and lower lows. Okay. Don't create too much out of it. When you see it visually, it'll make more sense. So uptrend looks like this, basically. So you see, it goes like a cycle. It bounces and it's cycle like that. If we suppose draw a straight line, that is how an uptrend will look like. Then we have the downtrend. Downtrend looks like that. Imagine there, market starts off and goes all the way down. So that is how a downtrend will look like. Let us see what a range market looks like. So that's an uptrend. That's a range. That's like nothing much is happening. It's like there's a lot of. There's no direction. Buyers and sellers are not trying. Not being able to make any kind of decision out here. So it's like ranging. It's going sideways. Some people say it's consolidation. It's traffic. It's not just, it's a traffic jam if you compare it with driving. So there's no direction in the market. And then suddenly it finds some direction after here, and then the market goes down. So that is a market going down from a range or a consolidation. Okay, so the next word, as you know, currency are traded in pairs. So it takes 2 to tango. So that is the currency you see in the front is called the base currency, and the other side is called the term currency. A lot of people call it the base and the quote currency also. But when the market is going up, like out here, then the base currency is going up. Always remember that. When the market is going down, the base currency is going down. So if it's euro against the dollar, euro is going up when the market is going up, and euro is going down when the market is going down, because it's a base currency. That's very important. Now coming to time frames. There are different time frames in the market, and so you can have charts in 1 minute, 5 minutes, 15 minutes, 30, to daily, weekly, monthly. And the higher the time frame, which is like the higher time frames are like, it starts from 4 hourly, daily, weekly, monthly. These are considered high time frames. The higher time frames, the higher the time frames, the more solid the price action. The more when I say solid the price action, it means the stronger the trend. If you see an uptrend on a 4 hourly, daily, weekly, monthly, then it is much more guaranteed that it's an uptrend. But if you see, a uptrend on a 4 hourly and a downtrend on a 5 minute, that doesn't mean much, because in the market, as you have seen, if I go back here, the market does that. It bounces. So on a 5 minute, you could have been seeing this one, or you can have been seeing this. So we don't know. So you cannot actually confirm a trend on a lower time frame. You confirm a trend on a higher time frame. Then you say, okay, fine, this is where the market is actually heading. And it takes about 3 touches. If you draw a trend line, it should take about 3 touches to actually identify and confirm that is a valid trend line. I see a lot of people drawing trend lines, and it really, it makes me, I don't know what the word is, but they just draw, a trend line with any touches and just says, it's a trend line. But the correct way of drawing a trend line is that it has to have 3 touches, like it has 1, 2, and 3, 4. That's a confirmed trend line here, and it's an extended trend line there. If you have only 2 touches, then that's a tentative trend line. Then we do not know as yet if the market is trending up. But here we can confirm, if it touches a 3rd time, then yes, that's a confirmed trend line, that market is going up. That's just one of the things. Then when you see, this is when you see in the charts, there are 2 ways. Well, there are more than 2 ways, but 2 most popular ways of chart patterns are candlesticks and bar charts. So when we go to the main, let me just share my screen here. Can you see my screen? Can you see the chart? Who was there? Yeah, you can see my chart. Okay, good. So this is the platform. This is TradingView, and if you see, these are called candlesticks, and these are called bar chart. Bar chart looks like this. So these are just 2 ways. It's up to choice. Some people like to see bar charts, and some people like to see candlesticks. So these are 2 different ways how people view charts. And I'll tell you the difference, how to see those charts. Let's go back to where we were. What is a bar chart? So a bar chart looks like that. You have an open and a close, and then that's a buyer bar, and a green is a buyer bar, and the red is a seller bar. It opens high, but it closes low in a day, and it can be in a day or a 1 minute. Every chart, every bar chart or a candlestick chart can happen in 5 minutes, 15 minutes, 30 minutes. But this is how we see the price opens here and the price closes here. I'll tell you how it works as an example. Suppose, let's say, for example, the price opened at 100. Tentatively, I'm just for example's sake. Price opened at 100. So the buyers, and then buyers came, sellers came, people came in the market, and they said, okay, the price opened 100, and then the price went down to 80, and then the buyers barged in and said, and took the price up to 200, and then it closed at about 180. So that is how a buyer bar is identified. Similarly, in a seller bar, or a red bar, as it's shown out here, price opened at 180, went up to 200, then again went all the way. The sellers really pushed in, and then it went to 80 from 180, and then it closed at 100. So that is how you identify a seller bar. Again, and you can have those bars in any of these of charts. Similarly, like bar charts, there are candlesticks. Now, candlesticks were thought to be developed in the 18th century by Munishia Homer. He was a Japanese rice trader, and he actually, we don't know before him what we. It's known that he developed candlesticks to go to the market, and he was a rice trader. He wanted something to identify, to say, okay, the price was this, and it came into this. And then later, Steve Nielsen was a person in the Western world who made it popular into the West, who actually got candlesticks charting patterns and techniques. And it's famously in his book also, the Japanese candlesticks charting techniques. So candlesticks charting technique is widely used by most traders that in the Western world and all over the world now. So how candlesticks works, like similar to a bar chart, it has an high, low, open, close, the four parts to a candlestick. And what we do, the high and the low, we just put as a wick. So remember when in the bar chart I said about, we mentioned about, it starts here and it closes here. So it starts at 100. So where it's open and the close, we have that as the body of the candle. This is called the body of the candle. And the high and the low, they are called wicks of the candle. And in the olden days, I think traditionally, well, I say olden days, traditionally, there were two. It's called the black candlestick and the white candlestick. But in the modern way, they use a green candlestick because, the uptrend, the buyer bar and the seller bar, as we call it, so the buyer candle and the seller candle, the green candlesticks and the red candlestick. If the close is lower than the open, then it is a red candlestick. Okay, so 1 second, let me just go back to there. And yeah, so if you see the traditional and the modern, this is how it looks like. Basically, you just have to remember, if it goes up, it opened and it closed higher than it opened, then it's a buyer bar. And if it closed lower than the open, it's a seller bar. And there are lots of candlestick patterns, but we don't need to know all of them. There are about more than about 200, if I'm not mistaken, more than 200 patterns. And there is a book called the Encyclopedia of Candlestick of Chart Patterns. And that book, if anybody has read that book, I can salute you, because I think, name it and chart patterns, not just candlesticks, those are chart patterns are there, but you don't need to know all 200 of it. And of course we won't be able to cover anything that much of it in this webinar, in this workshop. But maybe I know about 30 to 50, but and they're all over the internet. You can find them, 3 crows and huge. There are, but there are only about, say, 10 to 15 that you need to know to identify. What the candlesticks does is it gives us the candlestick patterns gives us a way to identify where the market is going. So these are some of the candlestick patterns which will let you know if the trend is ending, or is there a reversal, or is, these are reversal patterns, like, the bullish engulfing, the bearish engulfing, the harami, which is like like a baby, so it's giving birth to a new direction, and the dark cloud cover, and the piercing candle, or the rising sun. So these are some of the candlesticks. So what happens in the bullish engulfing is that you will see that when the market is about to go up, you will see that, and it's engulfing, as it says, it's engulfing the other candle. So it is a big indication to us that so far there were sellers, but the buyers have come in, and then look at how big the buyers are. It is engulfing the sellers. So that is how the name got, bullish engulfing. So when you see a candle like that, it just means that the buyers are barging into the market now. Get ready, because the market is going to turn around. So the candlesticks gives us this way of handling price, movement in price, and what is happening. Sitting out here in my small study in my house, I can figure out or have an idea or an indication that the markets, what the big boys and the girls are doing out there, what the big daddies are doing out there, and accordingly take a move in the market. So now talking about move, we need an indicator. We now know the candlestick patterns, and now we have to, the next ingredient is what other things can we use to find out which way the market is going. The next thing is called the moving average, or we need an indicator, any kind of indicator. In this case, I'm taking the case of moving average. So what is moving average? A moving average is basically an indicator. It's like a line that goes and it gives us an indication which way the market is going. There are different ways of, it can be a way to judge whether the market is overbought or oversold. And the distance between the moving average, all that also, I'll show you more when we go into the chart. So basically, a moving average, it works. Let me go to the next chart. Yeah, the shorter the moving average, yes, the more closely it fits into the price data, and the longer the moving average, it fits towards the price data. Once we see the moving average, let me show you here. So let me go to, say, candlesticks, and then there. So this is a candlestick chart, and this is euro. So if I just squeeze that chart in, and then you see how the charts have come in here. And now if I just plot a 50-day moving average, okay, so this is how a moving average works like. So if you see that, here was a signal triggered out here, just out here, it says, it has crossed the other side. So what we technical analysts look for is, has the price crossed the moving average? Usually people have two moving average, and it's called a moving average crossover strategy. So two moving average or three, it's taken. I know of people who takes 4 moving averages also, but 2 is the minimum. A 50 moving average is a very important moving average. A lot of banks, a lot of hedge funds, a lot of big traders, they use it. They also use the 55. I don't know why they use the 55. Maybe it's a Fibonacci number. That's why they use it. But the 50 is a very commonly used moving average. Another moving average they use is 20. Now, when 50 and 20 is crossed, have you seen here? It has just given us a signal. Let me just give you another way of there. If you see there, that's a 20 and a 50 moving average that has crossed. So once it has crossed, 1 second, let me just give you, oops, where is, I just lost my screen there. 1 minute. Yes. Okay, so once this moving average is crossed, the 20 has crossed the 50 moving average. That's a signal that the market has gone up. And then we can see here, the market has gone up out here. Now, if we see the moving average of, let's find out another moving average here. The moving average is crossed all the way down. So that's a selling signal that the market has crossed below. So we are following the blue line. When the blue line has crossed the red line, which is the 20 crossing the 50. Now, you can have any colors you want. Don't worry about the colors, but it's the 20 moving average crosses the 50 moving average. Then you have that. Then you have a buy signal, and that is one of the reasons that you can say, okay, fine. You can also have a stronger signal saying that yes, moving average is crossed, and you also have volume to support the case, or you also have another oscillator to support the case. So these are all ingredients that you use to make your case stronger to take a trade. So far, are you getting any kind of value? Are you just because I'm just talking to myself, I feel so sometimes it's nice to just interact. Is that can you just type yes if you're following this so far, or you're getting any value? It'll be nice to just type in yes. And is there any questions? I see there's a question. So is candlestick pattern the most preferred method used by expert? Where is bar charts used? Candlestick, yeah, you can use candlesticks, but it's a personal preference. Some people use bar charts because they find it's easier. They find it, it's just pleasing to the eye. And some people use candlestick because they feel that that's more appropriate and they find it easier. I started by using bar charts, but I slowly graduated to candlesticks. Then because I found it that it just aided me well. That if I used candlesticks and when I learned the candlesticks patterns, it just made my trading. I could identify, trading, positions that I wanted to take. So yes, I'm learning. Yes, so thank you so much. So let's carry on then. I'm happy to take more questions later. Now, coming back to another ingredient that we want to put in before taking a trade is support and resistance. This is detrimental. It's so important. Where is the support? Where is the resistance? Because that way we can trade in between support and resistance. Now, here, if you've seen, price hasn't gone beyond that line. That's a strong support line. And resistance here, price hasn't gone above. So if we know that this is the area where price is, now this is a ranging one. This is, but it's not the best. But as just an example, we can, plot support and resistance and then figure out, okay, we can trade within this area. Where is the price? Or where is the support? Or we can say, okay, this is consolidation. We do not want to trade here. But as soon as there's a breakthrough, price breaks below this level or above this level, I'm going to trade. I'm going to look for opportunities. So when you know that, it's much more easier to trade. Right. So I'm not going to waste much time on charts today. This is my last chart now because I have you said, I listened, and then because now we're going to go and go to the platform and implement what we have learned. Is that good? Do you like do you like that? Okay, so let us go through support, resistance. Let us go through the price action. Let us go through everything that we have learned today. Okay, so we've learned about trend lines. So can you identify a trend out here? Can you tell me, is that this one, this chart? Is this a uptrend or a downtrend? Is it can you type uptrend if you think it's an uptrend, or can you type downtrend if you think it is a downtrend? Or if you think it's a consolidation or a range, type that. So uptrend or downtrend or a range. Anyone? What do you see in this chart? Downtrend. Okay. Downtrend. Anyone? Downtrend. Okay. Fantastic. Downtrend. Okay. Downtrend. Okay, the answer is it is both, because this is an uptrend. If you see here, this is an uptrend. This is a downtrend. You write there, and this is a consolidation out here. This is a ranging out here, right? So when it is a downtrend, what do we look for? Once we know the bigger picture, a downtrend, we look for only selling. We are not looking to buy here. We are not looking to buy here because we know that, it is a downtrend. And it is a downtrend on a monthly chart, is it? Let me check. Let me see. So how do you know that it is a downtrend? Remember, we had spoken about, spoken about monthly, weekly time frames. The time frame is this. This is how the monthly chart looks like. Yeah. This is euro. Guys, this is euro USD monthly. That is how the entire currency, map looks like monthly. And this is from 2003. Yeah. No, 2002. So 18 years back. This is how the entire currency has euro. This is what euro has. So this is like history at one glance. That is why I like higher frame, time frames, because it gives you a bigger picture. If you are looking like, if you are staring close to the television or a big cinema screen, you do not see the big picture, right? You want a ticket, to go at the balcony or the VIP seats, like at the end of the, and the middle and the end of the theater hall, so that you can see the entire screen. So that is what bigger time frames are. It gives you the big picture. But when you come to the lower time frames, that is when you can identify and trigger a trade. Entry points, that is good. Where are you going to enter? Where are you going to exit? That is important for lower. Go to a lower time frame to enter and exit the market, and we'll do that in the next workshop. But to identify what a chart looks like, it is so much easier to see on a higher time frame. So that is a monthly. That is how monthly euro looks like, euro USD. That is how a weekly euro USD look like, and that is how a daily euro USD look like. You can just go all the way. Daily doesn't take all the way. So now, remember we said about support and resistance. So we now identified, what did we identify? The different kinds of trend. We now know that euro is in the downtrend. Now, support and resistance. Now, if I draw certain lines out here, would you say that that is that particular thing? It has touched a lot of lines. Where do you want to put your support and resistance lines is where it has touched lots of times. The more it touches that line, the stronger the support or resistance becomes. Do you understand what I'm saying? There is a question once again. How would you interpret the trend in this big picture? Oh, this picture, this is a downtrend because we are worried about, this is everything. This is also an uptrend and sideways and a downtrend. The immediate, the current, it's going on a downtrend. Yes. But if you look at the bigger picture, it has had its ups, it has had its sideways, and it has had its consolidation, gone up, and now it's again down. So the current picture is, yes, that's on a downtrend. So we're looking for to go with the trend. There is a saying that your trend is your friend until it bends. So you go with the trend, because it's like if you're going with the flow. If you're going with the trend, you're going with the flow. If you're going with the flow, it'll be easier for you. It'll be faster for you to go to ride the market. But if you're going counter trend, if you're doing something, identifying, or you're placing a trade in a counter trend, the market is going down, the market is going up, and you're placing a trade to go down, the chances are you are swimming against the trend, against the it'll be harder to because you're trading against the flow of the market. Now let's go to support and resistance. If I place out here, because if that line, if it touches here, it touches, well, let me just do a small line. That line, let me just do that line. So that line touches here, 1, 2, 3, 4, 5 touches. So don't you think that is a strong indication that that number 1.05467 is a very strong number that you can fall back on, saying that is one of the lowest point where the euro has gone. Similarly, let us draw some other lines on resistance. Okay, like for example, there it's gone 1, 2, 3, 4, 5, 6 touches. That's again another where the market has gone beyond that. It can be here. Let us say now, this is these are some of the lines where market has stopped. Somehow it's like those bouncers that you see. It doesn't let you enter the VIP, the line to go inside the, the whatever, the nightclub or the casino or wherever you go. So these are the bouncers. It only lets in if you cross those are big lines to cross. So if what experts or technical analysts look for is that those lines, and those lines are very important. And also there is also something called psychological numbers, like for example 1.2000, any of the zeros there, those are called psychological numbers, and those numbers are also very important, because for some reason price comes and stalls there. They're looking for the next psychological number to go there. So now that I have the bigger picture and have drawn these lines, now let's go to an hourly or a daily chart. Okay, let's go to a daily chart. Let's break it down there. So where is it? Sorry, not that. Now if you're going here, can you see the price actually touched there, and it's on the way, I mean, hasn't touched there as yet. So do you think that it is going to make much of an effort to just trade within this, if you want your stop loss and your target can be, you can have some kind of idea where to place your stop loss, where to place your target? Yes. There's another question for beginners. What's the recommended time frame to use? There's nothing called beginner's time frame. I always there was a study. It's very interesting question. Thank you for that. There was a study in Harvard that said that they had X amount of traders take trades on a shorter time frame and a longer time frame, and the winners were the longer time frame ones, not the shorter time frames. So that is a very interesting article. I thought I read it, and I think I know of somebody who had done this. Anyway, there was but I remember that it was a higher time frame that won, not the there were people who made money were the ones who traded on the higher time frames, not the lower time frames. So that's very interesting. But then again, there are people who scalp the market. Scalping is just taking like little bits, like 5-10 pips of the market every half an hour or everything like that. But then you need also a lot of time to sit in front of the computer and look for those trades. So higher time frame is much more easier. It also depends on your trading style. So it's just you do not have to sit in front of the computer. You can do swing trading when you are there. You can just place a trade or an order at night, and then you can go to bed, and if it triggers during the overnight, then you are on the trade, and provided you have your stop loss and your target profit taken, already placed there. So higher time frame, definitely there are more opportunities. It's a personal choice at the end of the day. So if you see here, there's another question: the support and resistance makes sense of risk mitigation. Support and resistance also gives you this is where this is the ceiling and the floor, and you can trade in between that. Or you can also think that, okay, fine, this is where the support and resistance is. If it breaks that resistance, it's going up. If it breaks that support level, it's going down. It's nothing is 100%. Of course, it's the markets. Nothing in the market is 100%, but it gives you an idea that there are more possibility. If those levels are broken, then they're going to the next level. Then they're going to the next level, up or down. And you follow that trend, basically. Okay, so, and now coming to a little bit more in depth. So if you see here, that line, that is a support line that is happening there. If you can see there. So if I am supposed trading from here, I'm not taking the trade or anything. I'm just saying that, for example, say, will I place my stop loss here and then take that market from here to here? From here to here. Yeah. That, just as an example, because that is, that is where the price is not going beyond that. Something must be there. So let us, give some importance to that level. And then from there, the market can go there, and the market can also go from there to there, or there to there. We don't know. But we know that that is the line, and we know that that is the line because it hasn't gone from there to there. Does it make sense? Can you type a yes, or, getting it, interesting, awesome, like it, or stop it, or can't be bothered, whatever. Anyway, so yeah, so that is support level, and support level is so important, so important when you start trading. So the next we had said is we spoke about was the trends. We now know uptrend, we now know downtrend, we know a range, what a range looks like. Let me know if you want me to show it again. I'm happy to do that. But well, which is see that is kind of a range. It's not doing much. The market is not doing that. That is a huge range. If you see that is a that is a range. That is a ranging market. For about from January 2018 to April, 4 months. It just did that. Now, there's nothing much to trade there. Some people will say, yes, there is a strategy for ranging market, but yes, there is a strategy for everything in the market. But, most of the money is made when a market is trending on a trending market. So what usually one of the strategies that one can I can show you one of these strategies. When the ranging market, when do you know the market is turning? Okay, so in this one we can just take a measurement of, okay, fine, that is the line, that is a support line, say. Okay, so that is the support line, right? It's not the best to wait. Okay, that one, so that is the support line. Now if we measure this one, okay, just take an arrow, measure it, and then let me clone this copy. Clone. Now, if I clone this and I trigger it here, and I just wait when this market breaks through this one. So I have a target of, this is called a measured move target. Okay. This is called a measured move. So means that where the market has been consolidating, if you measure that price and wait, trading is about patience. It's about fishing. It's like, you wait for the right moment. So when that is, you have an alert out here, you can just place an alert saying that, okay, let me know in the platform. You can just place an alert and say, when the price crosses this, just send me an alert to my phone. And then you can wait, and then your phone goes ding, ding. And then you come back to the platform and you say, okay, I want to enter here, stop loss here or here, and then this is my measured move, and then boom, this trade would have been a good trade. So, and then this would have been my measured move that you would have exited there. So that is how you trade the market. You just have a measured move. So more examples, definitely. Sorry, let me just take this out. Okay. And another thing, need more examples to get in my head. Of course, this is just a beginning. It's like, it's like, how will I say? It's like, songs, you have different songs. Suppose you have an R&B, you have classical, you have hip hop, rock. You need to listen to at least 4, 5, or 10 of them each to understand, okay, this is what R&B looks like or sounds like, or this is how a classical sounds like. Similarly, just open the chart and just just get to see more charts, the more you see the charts, the quicker you learn. And feel free to come back to me with a screenshot of saying, do you think this is right, this is wrong, or when we have a question answer sessions in the group, feel free to come and show it to me, and then we can take it from there. So next we trend line, we did candlesticks, we did uptrend, downtrend, and then we did ranging market, bar chart, time frames we did, and then now we comes to the last one, the moving average. Now moving average is, again, it is a way of telling us where do we enter and where do we exit. Is there an opportunity in the market? So suppose, for example, we are here now, and then we have the moving average of 50, and we have the moving average 20. Now, moving average only works well. It works, but it works well and better in a trending market, not on a ranging market. Most of the indicators, they work on a trending market, but there is also a saying that the most indicators are lagging indicators, meaning that they tell you about what has happened in the market and not what is going to happen in the market. But some say it's better to get in late than not getting in there forever. So here, for example, there, if you can see, is one of that. Yeah, so there is a moving average that has crossed out here, right there. So you've seen, and it has crossed here again. So when you've crossed here, this is the chart that you're going to get in. Let me just make it a bit bigger. So this is where it crosses. So you get in here and you trade here, and then boom, this happens. So when this happens, this is an engulfing candle. That's an indication that, okay, market might go down, and it did. And then it crossed here. So this is where you're going to get out. This is where you're going to get out anyway. This is a sell signal again, but do you see it is not that great because there are a lot of whipsaws here, because it's a ranging market here. It's not a trending market. So you will get a lot of false signals, which is called whipsaw. But let us go to a trending market, something that has a longer trend. There you go. So remember I said that, mentioned that one. Yeah. This is where the market is ranging. And now, after that, this is where the indicators already has crossed out there. Don't you think that is a sign that, there might be something happening now, that the indicators have crossed? And yes, after that, that's a number one bar chart. Let me just go in bigger. So one bar chart, one bar candlestick, 1 second candlestick. You can enter out here. That is where it crosses. So you'll miss about 1, 2, 3, 4. You'll enter out here in this, but that's still a long way. I mean, if you enter here and we do the measured move, remember? Even if you do, so we have identified where to enter, right? We enter here, and then we do a measured move to exit here. If we exit here, we are still there. But the moving average will tell you that, hang on, it's still downhill. You don't have to move, but you can just say, okay, fine, I want to break even here, or I want to take part of my money out here. But I'm still there because the moving average is giving me enough indication that the market is still going down, right? So you can go from here to here. So which will be, so you'll get down here. There are 27 bars. That's a lot of pips there. There's a lot of pips there. You can make a whole lot of good money. And that's 27 days, because it's a daily bar chart. Yeah. So doesn't it make more sense to just have and more confirmation about when to enter the market, when to exit the market? You might exit here because it's going to a consolidation, or you might exit here. But you would definitely exit here because it's crossed. It's already crossed, saying that, okay, fine, I might go up. Moving average usually works. I mean, moving average is something that is used by a lot of banks, by hedge funds. But at the same time, it's not the only indicator that you depend on. There's a lot of other indicators also, like Ichimoku. The systems, these are called Bollinger Bands. Those are different trading systems that we have that we can use. But moving average is one of the simplistic indicators that you use. And then another thing you can use is the volume. Volume is what in Forex. Volume is not important because it's a decentralized market. If you have, when we had said earlier about centralized and decentralized market in the first webinar, in the first workshop, but you can use volume outside of Forex. Volume is a very good indicator, saying, okay, fine, there is a lot happening in the market. So yeah, this is what we have planned for today. Anything else, you let me know. I am happy to do some more question answers or chart patterns. So if you have, let me see if there's any questions. Support resistance makes sense for price transformation. Okay, fine. Let us see some other markets if we get to see. Do you see how he pound? Let us do some little bit of candlesticks to identify what happens in the market and what it identifies. For example, this is a bearish engulfing candle. It is, if you can notice, that candle, the red candle, is far beyond. It's gone far beyond the previous candle, saying that it's an indication that I am ready to go down. I am ready to go. And it happens on the top of the market. You won't find that on the bottom of the market. You find it on the top of the market. Another very important and common sign is that candle. It's called a doji. And that is a gravestone doji. Doji meaning there is no decision. It's an indecision candle, which means that it opened, it went up, it went down, but it closed at the same price. Same price it opened in the beginning of the day, which means that there is, the buyers came, sellers came, buyers took it up, sellers took it down, but then nobody could decide what what price it will take it to. So there was a huge indecision in the market. Now, when you see a gravestone doji, DOJI, it means that there is going to be some reversals or some change in the market. And yes, lo and behold, the next day we had a seller bar, which means the sellers came in and it just pulled the market down for 4 or 5 days. So a doji is something, if you identify dojis, you find dojis usually on uptrends. And in the downtrend, you find hammers. See, that is a beautiful hammer. I would take that trade any day. So hammers are something, it just says that, and it's a green hammer followed by a buyer bar, which means that, yes, I'm geared up to go up now. So hammers you find in lower part, even in the support levels of the market. In a downtrend, you find a hammer. See, that is going up. Let me just go closer. If you see seller bar, seller bar, seller bar, seller bar, and then that's a hammer. What is a hammer? The wick is quite long. It looks like a hammer, and it's a green bar, and the preceding bar, the next bar, opens here, and it's way beyond the hammer. It's taking charge. It says that the bulls are ready, which is the buyers are ready now to take over the market. So you enter here and then you get on here, crosses it and gets out here. So that is how you trade. That is exactly how you trade. So candlesticks is important to understand. Hammers, dojis, dark cloud cover, bearish engulfing, piercing candle. There are some of those, but those you'll not have it in a day. It's about doing it. You learn. Trading is about learning every single day. It's like a skill, like a guitar. You cannot just take up a guitar and become Eric Clapton on day 2 or 5, but don't let that overwhelm you. You cannot play all the songs of the guitar on day 1, but you can make progress day after day, day after day. The more you do of it, the more you see the charts, learn from the charts, and come to our workshops and our question answer sessions, ask questions, do it, the more progress you'll make. So there's another question. Yes, who's that? Oh, so when the buyers are ready, that means I should sell, right? No. When the buyers are ready, you buy. When the buyers are ready, you buy, because you're going with the flow. That is stock. Stocks are different. So you go with, if you follow the buyers and you follow the sellers in Forex, you follow the big boys and the big daddies and the big companies, because we are not market makers. We do not move the market. The market is moved by the hedge funds, the banks, and the people who are who has the big money to move the markets. So we just follow the market accordingly. We do what they are doing. If we see the market is going up, we follow the market and we buy there. We When you see there are sellers, more sellers in the market, you want to be in the gang where there are more people. So if the team sellers increase, you go in team seller in Forex. And if you go if you see team buyers, then you go to team buyers. And it will only happen if you see just uh, don't think about it so much. It will come from doing more of it. It's like honing a skill. uh, like that, it's the sellers have started going, the sellers have started coming out here, and that is a big indication, and a nice candlestick saying, yes, I'm ready. Yeah, that's a dark cloud cover, like a cloud cover. If it rains, what happens? The cloud is covering, it's becoming dark. So that's a dark cloud cover. In fact, I wrote and I was blogging about it, about the indices market, and how how we saw a dark cloud cover. I'll show you if I can find that blog there now. I'll just send in the comments. I can send it. So this is a dark cloud cover. When you see a dark cloud cover, get excited. Get excited, because there's going to be some movement in the market now. So that's a dark cloud cover, and this is what happens. So the sellers are starting to go ready, and then once the sellers are there, you just follow the sellers. Okay. Oh, hi, Keaton. Good evening. The question is, what would be useful to see is you doing some live trades and taking through the analysis you do along the way. This will help us build confidence. Perfect. I will do that. I am going to do that in the third workshop. Now I don't know where this is not the right time to take a trade, but this is a trading view where I do my analysis, and I'm happy to do that in workshop 3, where I take you through the trade. I mean, I take you how to place the trade. When we are placing the trade, then we can show you what are the things that I go through, what boxes do I tick, and then how do I place a trade. It will just be a demo trade, but I'll just go through that, if that helps. Ketan. Yeah, can moving average be used on short time frames? Yes, moving average can be used in short time frames. It can go to a lower time frame. You can use anything on any time frames. You can use candlesticks, indicators, oscillators in all time frames. But the quality of the price action is basically price out here. The candles, the price that's going on these. The price action is better on higher time frames. It is much more. It's, they say the higher the time frame, the more better the price, the quality of the gauging the market, which way the market is going is better. And then when you enter the market, yes, then enter in a smaller time frame. Then you can enter in a 5 or a 15 minutes time frame. Thank you so much for this wonderful workshop. Well, thank you. Welcome. I hope for more interaction ahead. Okay. Oh, you're from Pakistan. Oh, thank you. Okay. Stay blessed. And see you next time. Yeah, it should be late, but thank you for staying awake. Thank you. Are there any other reading materials or resources? Oh yes, I can send you some reading materials in the comment section. But the best way would be to go ahead and read about candlesticks pattern. Steve Newson's Candlestick is a good book about market patterns, about technical analysis. There's a book on technical analysis by John Murphy. That's a very good book. Anything with Van Tharp, he writes Trading with Matrix. That's also a very good book. Trading for a Living is a very good book. Then the New Market Wizards. That book is Market Wizards. It's about people who has who are successful traders. So that will give you a lot about psychology, and psychology is quite important, the trader psychology. Mostly it comes from experience from being a trader, but you can also understand from where they are, because they have already been in the market and they have been through those emotions. So it takes, as they say, about a year or 18 months to to actually have each and every cycle of the market, trading all the cycles of the market, so that you can just figure out that, okay, fine, this is how what happens in this kind of scenarios. Now, for example, here, in a pandemic, nobody has traded a pandemic. I mean, how can you can tell people that, okay, fine, you have traded a pandemic, you can tell your grandchildren. It's like the Great Depression. We don't know. So trading that every single day, oh gosh, yeah. So it's an experience. I trade here. I Let me just share my. This is where I trade, and so this is one of the other ones. This is one of the accounts. This is not the main account that I have. This is just where I do my analysis and what you call it. Uh, this not my main account. This is just a demo one, but. Yeah, I did some of them here. I was trying one of the, and usually do NASDAQ here, and then figure out and do it in my main thing. But if you see, where should I show you? I like NASDAQ a lot. It's an indice, I know that. But yeah, it's, this is Ichimoku, as you can see. This is an Ichimoku. I haven't touched on Ichimoku. That's one, again, like moving average. Ichimoku is again one of that, and some of the histories that I've done. Today was a good day. Today was a very good day. As you can see, I've made about nearly 500 pounds there. But yeah, then yesterday was also a good day. But this is how you trade. This is how you trade, and this is how you figure out how to read the markets, how to. Hi, Nana. Hi, Nana from South Africa. Thank you for joining us. You're using Ichimoku there. Do you always use that indicator? I do love Ichimoku. I have a great thing for Ichimoku, because, and I think Ichimoku is also, it helps beginners. I know a lot of people use moving averages. Oops, sorry, that's my glasses. But Ichimoku gives you a support level, and where is that? Let me show you here. It gives you, like, I know this looks busy, but it gives you a lot of stuff that you can use the span B as a stop loss. You can also use the Kumo as a stop loss. And because the Tikan-sen and the Kijun-sen, it crosses, it's like a moving average crossover. There's a lot of things for beginners when you don't know, when you're still getting to know support, resistance. It gives you a lot of place to place your stop loss and your support levels, where to get in, where to get out. Ichimoku already has it. It's called the one glance chart. It's again Japanese, but it gives you a lot of indication. And yes, I teach them to some of my students out there, in my sessions. But Ichimoku, I love Ichimoku, and then it is something that in the beginning, it looks scary because it's a very busy chart. But it's not. It's just getting used to it, and I'll show you how you can, place things one after the other and get used to the chart. Now, coming back to some of you have. Asked me that can we carry this on, and I like the way how this small group has suddenly now became into in a close knit community. I love it. I also had done a poll because I've got a lot of people asking me for classes, and I cannot take one-to-one because I also trade. So I had created a poll, and where is the poll? There was something there. Wait. There was poll. If you go to the group, where is the group? There is a group. Can you see the group? Yeah, so this is the group. If you go to the announcements, and where was it? Yeah, so I created a poll out here, and then asking you what you need. Do you need like a high value course or a foundation? A lot of people said no, they want just do virtual things, classes. So I think that might be the way going forward, to have a monthly two different classes, one membership, and on a membership basis. So I would like to know if you would be interested. Can you just type in I am in, or anything like yes or I am in, if you are interested on a ongoing lesson. There'll be two lessons, two sessions from me every month. One will be a question answer session, and one be a lesson session, because trading is more about going, it's about progress, about learning a skill. You can't learn in one day. Kindly give a session on Ichimoku. I am in. Okay, fantastic. So if I get enough I am in, whenever, maybe I can figure out a way to go ahead and create a membership, and then find out what we can do further from then. Every month you will get one lesson, and you'll get one question as a session from me. And people who want more than that, we can do something later, but I want to start from a basic level. Yes, so there you go. Yes, I am in. Yes, thank you. Sure, I am in. Oh, that's fantastic. You want that. That's nice to know. Okay, so let me see how can, well, maybe I will find out what would be the best way. I will let you know in our next class, which is on the 1st of May. And we can start it from that day onwards, or I can announce it there. So make sure you are here live again. I'll be on the 1st of May. I'll be giving the last of the 3 workshop. With the membership, teach us how to trade. Yes, the lessons will be about that. It'll be an ongoing. it'll be a hand holding, in a sense, hands-on. You can. I will not tell you where to trade. Of course, when I'm trading, you can. If I see something, but it's not going to be a signals. If you know what signals are just, it's a service that you just pay to get in, get out. You don't know what is behind that. Is it a robot? What are they taking? It can be anything. If you don't know, I know some people are good. I can show you that, but it's not going to be about signals. It's going to be about education. It's about, if signal is like giving you fish, about selling you fish, our membership will be about teaching you how to fish, so that you are independent. So and along the way you learn and you trade on your own. Until then, yes, if you have to support yourself with signals or anything, that yes, I can show you, I can guide you where to find them. But the whole idea is to be independent. Yes. Okay, so I have come to today's the end of today's lesson. So if in case you are watching it on our page, do go to our to facebook.co.uk, forexdiva.co.uk/24fx to download your, if you haven't already, to download the PDF, and then you can come to our Facebook group. And thank you so much for being here. I really appreciate this. And have a good evening. And from everywhere in the world, I'm so honored to be here and to serve you. And thank you for your time. I hope this has been useful to you and for you. And take care. These are tiring times. It's it's hard. There's a lockdown happening, but it's nice to share a few moments with you and share whatever knowledge I have about the charts and on the financial markets. And I can't wait to see you next time. So take care, and bye for now.